Chapter 10: Reporting and Analyzing Liabilities. The objective is to account for current liabilities. Liabilities are present obligations that result from past transactions. These obligations must be paid sometime in the future by the transfer of assets or through the provision of services. This future date determines whether the liability will be a current liability or a non-current liability. So for example, if we purchase inventory on account, because we purchase it on account, it's a liability. So we would debit our inventory and credit the accounts payable. A current liability is a liability that will be paid or settled within 1 year from the date on the statement of financial position. A current liability is settled through payments by cash, through the transfer of goods or services, or through the creation of other current liabilities. Most companies pay current liabilities with current assets, such as cash, rather than by creating other liabilities. All other liabilities are classified as non-current or long-term liabilities. Common types of current liabilities include bank indebtedness arising from operating lines of credit, accounts payable, accrued liabilities relating to income tax, salaries and interest, unearned revenue, notes, and the current portion of long-term liabilities. We have discussed entries for many of these liabilities in our previous chapters. So in this section, we will be discussing in more detail operating lines of credit, sales taxes, property taxes, payroll, notes payable, and current portions of long-term liabilities. Operating line of credit. The amount of cash a company has available may be less than it actually requires. So companies may borrow cash from banks or other financial institutions by obtaining an operating line of credit. And this is also known as a credit facility to help them manage temporary cash shortfalls. This means that the company has been pre-authorized by the bank to borrow money up to a preset limit when it is needed. Interest is usually charged at a floating interest rate on any amounts from the line of credit. A floating or variable interest rate is one that is not fixed and is usually based on the prime borrowing rate. The prime rate is the interest rate that banks charge their best customers. So for other customers, banks will usually charge interest at the prime rate plus a specified percentage that takes in consideration the risk of lending to that particular customer. Security, or which is called collateral, is often required by banks as protection against a possible default on the loan by the borrower. Some examples of collateral may include property or investments. Amounts that are drawn on the operating line of credit result in a negative or overdrawn cash balance. When used, it results in bank indebtedness. As customers, many of the products and services sold to us are subject to sales tax. Sales tax is expressed as a percentage of the sales price. It may take the form of the Goods and Services Tax, or GST, Provincial Sales Tax, or PST, or Harmonized Sales Tax, or HST, which is a combination of GST and PST. When a sale occurs, the retailer collects the sales tax from the customer and periodically remits the sales tax collected to the designated federal and provincial collecting authorities. If a customer pays in advance, giving rise to unearned revenue, no sales tax is recorded until later when the revenue is earned. The amount of sale and the amount of the sales tax collected are usually recorded separately by crediting two accounts, sales and sales tax payable. An example of this is on page 525 in our books. When sales taxes are eventually remitted, the sales tax payable account is debited and cash is credited. All sales tax it collects from customers will later be remitted to the federal or provincial government, and the amounts collected are a liability until they are remitted. Businesses that own property pay property taxes each year. These taxes are charged by municipal and provincial governments and are calculated at a specified rate for every $100 of the assessed value of the property. Property taxes are generally for a calendar year, although bills are not usually issued until the spring of each year. So in other words, even though a property tax bill may cover the period of January through December, it is not usually issued until March, which is well after the property tax year has begun. Upon receipt of the property tax bill, assume say in March, an expense is recorded for the months that have passed. So say in this example, January and February. So here on March 1st, we have property tax expense, and say our property tax expense is $6,000. So we'll calculate the 2 months that has passed, 2 divided by 12, and that should give us 1,000. So we debit our property tax expense and credit property tax payable of $1,000. When the property tax is paid, so assume say in May, the expense is recorded for the additional months that have passed, and prepaid is set up for the remaining months. So in this example, we will debit our property tax payable of $1,000, which is for January and February. Then we create a property tax expense for the months that have passed. So remember that we have March, April, and May. So here we have 6,000 times 3 divided by 12, and that gives us 1,500, which is debited. Also, since payment is being made for the remaining 7 months of the year, from June to December, a prepaid asset relating to these months is also recorded. Then we credit our cash account of 6,000 for the payment. At the end of the year, we clear our prepaid property taxes. So as in this example, on December 31st, the prepaid property tax that we paid back in May for June to December, we will debit our property tax expense of $3,500 and credit our prepaid property tax for $3,500 to clear the account. Payroll. As employees perform services for their employer, the employer incurs 3 liabilities related to the employee's salaries or wages. 1. The amount owed to employees. 2. Employee payroll deductions. And 3. Employer payroll obligations. The first type of liability is the amount of salaries or wages owed to employees. Management and administrative personnel are generally paid salaries, which are expressed as a specific amount per week, which is weekly. Per 2 weeks is called biweekly, and per month is monthly, or per year, which is known as annually. The total amount of salaries or wages earned by the employee is called gross pay. The second type of liability is the amount of employee payroll deductions required by law to be deducted from the employee's gross pay. Thirdly, the employer is required to withhold the amounts known as payroll deductions from the employee's gross pay, which is then remitted or paid to various other parties. Some payroll deductions are mandatory, while others are voluntary. Mandatory payroll deductions include amounts withheld for federal and provincial income taxes on the employee's earnings. In this way, the government receives income taxes from employees every time the employees are paid. Other deductions include Canada Pension Plan or CPP contributions and employment insurance or EI premiums. Companies might also withhold voluntary deductions for benefits such as health and pension plans, union dues, charitable donations, and for other purposes. The third type of liability is employer's payroll obligations. In addition to the liabilities incurred as a result of employee payroll deductions, the employer is also obligated to pay into programs such as CPP and EI and into provincial government programs such as workers' compensation plans. All of these amounts, plus any items pertaining to employer-sponsored health plans and pensions and compensated absences, holidays, and vacation pays, for example, are referred to as employee benefits. These are not amounts withheld from an employee's pay, but instead are additional expenses incurred by the employer. Short-term notes payable. A note payable is a promise to repay a specified amount of money, either at a fixed future date or on demand. Notes payable are often used instead of accounts payable because they give the lender written documentation of the obligation, which helps if legal action is needed to collect the debt. Notes payable are also frequently issued to meet short-term financing needs. Notes can be issued for varying periods of time. Notes that are due for payment within 1 year of the statement of financial position date are classified as current liabilities. Most notes are interest-bearing, with interest normally due monthly or at maturity. Current maturities of non-current debt. So this relates to the portion of non-current debt that is due within the current year or operating cycle. This should be classified as a current liability. So for example, if you were to take out a 5 years mortgage, the amount that is due for the current year, that is what would relate to the current liability.